Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be taking a look at 5 stocks with ex-dividends next week. We're going to be covering more than 5 stocks, but for the sake of it, we're just going to be making a video this week. I'm trying to reorganize my website so that when you visit the homepage, it'll be more friendly, a much friendlier layout. So if you're there to look for information on IRAs, 401ks, articles on specific dividend stocks or just dividends in general, what is a dividend and such, then it'll be organized with specific categories instead on the homepage, which will make it much easier for brand new viewers and just recurring new ones. So in this video we're just going to be focusing on finding 5 stocks with ex-dividends next week that have positive free cash flow, revenue, net income, have a yield, we'll say, of higher than 2, and a PE ratio less than 25. So let's go ahead, and if you are brand new to my channel, I do make stock market and investment videos weekly, so do consider subscribing for that. I'm over at Dividend.com. I clicked on the ex-dividend dates, and I've already sorted my stocks. I have a whole video on Dividend.com and how I find ex-dividend dates. There's a video, I'll link it in the top right corner if you guys would like to click. It says how to find ex-dividends. You can click on that. Otherwise, let's go ahead and continue. Now, I have these sorted by their strength, so that just means that they've had dividends. They've been paying out dividends for multiple years based on their rating. They increased their dividend. They haven't cut back their dividend some time. They have good yields. Their revenue is supposed to be positive over the next 4 quarters, or supposed to be positive. They're not going to be negative, so I organize them just by how their strength. So we have Honeywell right at the top. Next, I'm going to go over on Y charts and begin entering these stocks into Y charts. Now again, I have another whole video on Y charts and how you guys can access that website for free. It's on my YouTube channel. I'll have that link in the top right corner as well. If you guys would like to check that out, go ahead and check that out. I have a link in order to get to their website for free and begin using the charting system for free that they offer. I think that's great. It gives a very fast visual representation of just stocks in general. So I took all the ratings from 3.9 to the last one here, General Electric, at 3.4. So IMP is actually a pretty good company. I would consider that, it's a paper company. There are only a couple of one. I believe the other one's like SAN, I think, is the other paper company, or they or SON, S-O-N. But anyways, I went ahead and just took the top contenders there. And here we can see that all the ex-dividend dates here are semi-sorted, not really, but 19th is Monday, 23rd is Friday. So you can see here, this is what, Wednesday here, this is Tuesday, Monday. So, oh, okay, 19th is the Monday. So most of these are on Tuesday or Wednesday right near here. Very little Monday ones. So you actually have good time to buy. Anyways, next step is I'm going to go ahead and uncheck Delta Airlines. Let me see here. I put in a symbol RHI. I put the wrong symbol. There we go. I put Guggenheim. Yeah, I don't want Guggenheim. Anyways, my next thing here is to uncheck all of these. And my first step is to remove anything with a high PE ratio. So I'm going to go ahead and just mark a few of these at a time, and then remove anything with a PE ratio higher than what the average is for the S&P 500 right now, which I believe is like 23. So Microchip, we're throwing that one right out. And that gives us Honeywell, which has a 70. I don't think that's correct, but let's go ahead and toss that one out as well. And that leaves those ones in there. Let's continue here. Let's add a couple more. We have Sydney with 108. We have, let's see, Little Fuse, 38. 34, Evercore. Haven't heard of that company before. That rhymed. Hershey's, and it's pretty good there. Next is Avista. Let's go ahead and see if we can check all of these and just kind of, yeah, so we got TE we can remove, higher than 23. We have Avista, which is 24. And let's see here. What is Robert Half International? That's added 23. I'll go ahead and leave that one in the mix. So next, let's go ahead and remove anything with a yield lower than 2, just so we're buying some dividend stocks. You know, we want the dividend. Let's see here. We have a 1.7 with Discover Card. And we'll leave that one in there. The AFL, 2%, not too bad. Let's see, we have a 0.91 with Barnes Group. We have a Delta Airlines, which is 1.94. Delta Airlines, I would consider that more of a growth stock, but with rising oil prices right now, and just the whole way it's been kind of going on. Warner Met, that must have been the wrong ticker, but anyways, go ahead and remove that. And Warrior, oh, I may have removed the wrong tickers. Oh well. So now we are down to a little bit smaller list. Let's go actually just blow this up, and I'll zoom in here. There we go. So now we have a little bit zoomed in. So the next thing is I want revenue, free cash flow, and net income over the last 5 years. That has been positive. So I'm going to go down here and just enter percentage change and target their free cash flow and revenue has gone down, but their net income has been going up. So if we don't want to have anything in the negative over the last 5 years, this is retail. So I'd rather not. This has been a great growth period. A lot of companies, they should be having great revenue, great net income, increasing free cash flow. I mean, free cash flow itself is not bad. It's not bad to have it either negative or positive. With negative free cash flow, that could mean they could be doing acquisitions. But in this case, the revenue has been decreasing. So I'm going to go ahead and remove this. AFL, decreasing revenue, decreasing free cash flow, but positive net income. So they're decreasing their revenue, but they're maybe increasing their prices, which would be driving their net income up. That could be causing the price. Let's see what the price looks like. Let's go 10 years here. So they've done pretty well through the recession period. They recovered it within 2 years. And then they fell a little bit down during this little 2011, 2013 area. But they've been pretty good overall. Over the last 10 years, they're up 108%, which is 10% on average for each year. So I'm going to go ahead and, what was it? Was it positive on the other ones that we took a look at? Let's just go look at 10 years. Because that was the last recession, but everything should be positive over 10 years. Well, let's go ahead and see. So here we have negative revenue, negative free cash flow. So go ahead and remove that. That's positive. We have positive there. We have negative net income by 357%. L brands, look at that net income been increasing over the last 10 years very nicely. Down in revenue, down in free cash flow. And General Electric, we know their story. They are down in their net income, they are down in their free cash flow, they are down in their revenue. That is why their stock has plummeted as of the whole earnings and the way that they're taking their company and such. So that leaves us with really 4 stocks to really take a good look at here. So of these 4 stocks, let's just take a look at their price, their dividend yield, their price to book value, their PE ratio, and that's pretty good for now. And let's go ahead and normalize it. So this is normally what we look at on the website. We can see that they pay out right now 52 cents for each share each quarter, which is very nice. Looks like they increased it huge right back in this time frame. Looks like they had a steady increase for quite a while. You can see even during the recession period back in 2008, they increased their dividend through that. I believe AFL's been paying dividends for some 44 years, somewhere along those lines. If we hit the max chart here, you'll see a nice steady dividend. And then 2008, they huge jumped their dividend up, and just up. So very nice, consistent dividend growth and consistent dividends, even through recessions. 2008 recessions, the next recession, AFL, very good business. Let's go back to 10 year. Currently priced at $86.90. Were they affected by the the recent correction, it doesn't look too bad in comparison. They've been corrected before back in what looks like 2017. It did have a bit of a correction, but then they just easily recovered it. So it does look like a pretty easy stock. But their price, you can see here, between 2008, it did fall hard and didn't really fully recover and stay positive until 2014 and 2016. There was a period between there where it went negative too, and then that's 2000, end of 2016 going into 17. That's when it began to get positive. So this one, if you bought into it and you got into the negative, eventually you would probably get out of it, unless you're buying it up at this high point right now. That could be pretty risky. Next is Southside. Now this one is a mess right now. So these little spikes in blue, let's go ahead and get rid of the price. Let's just take a look at this over the last 10 years. So these are special payouts. So whenever you see these spikes here, these are special payouts to the shareholders. So they have a very nice, consistent dividend increase. That looks like during 2008, they did cut their dividend or perform a stock split their dividend, but then they rebumped it back up very quickly, and then ever since that point have just paid out special payouts during that time frame. They're currently priced, let's see here, we have their price to book value. Oh, I didn't see the price to book value of AFL. Oh, they're at a 1.39 price to book ratio. That's actually pretty nice. PE ratio sitting at 7.8 in comparison. It was nearly at a 13 just not even a month ago. So it's came down quite a bit. Whereas Southside hasn't been hit as hard due to the last correction here that's been taking place. So take a look at their price here. Their price has been pretty sporadic. Price to book is at a 2.1, PE ratio 17.91. Dividend has been pretty steady with special payouts, and they currently have a dividend yield of 3.16. Ticker symbol DNB. Looks like they had a special payout of some sort, or maybe they increased it here. Let's just take a quick look over at Dividend.com. We could take a look at here. So they've had dividend growth for the last 11 years, since 2007. This looks like possibly 2009-ish time frame. Let's see what took place back then. Yeah, they did a stock split, 0 for 1. So for every 1, you got 0. So maybe they went private. That could be. Oh, it looks like they decreased their dividend to very tiny. Okay. So in comparison to, yeah, they probably cut their dividend out completely here. Let's see, I can't even zoom in that. Oh yeah, it looks like they did a stock split, paid out dividends for just a very small time, and just cut it out completely in 2001. And here's where we're looking at the graph data at. Looks like they may have went public again in 2007, and then that's why it shot up like this. They were paying no dividends, and then they shot up to paying out 25 cents a quarter and such there. Let's see here. PE 13.62, price to book 1.22, price is at $20.02, yield 3.32. And L Brands, I think L Brands has done very well. Let's take a look at just its dividend information here. I should probably just do that one at a time. So L Brands has had consistent dividends. They've had special dividend payouts. These are what the spikes are. If you go to dividend.com and look at their information here as well, it'll show you the special payouts. What's their ticker symbol? LB right here. And you slide all the way down to the bottom, and you can see these little marks right here. If you highlight over them, special payouts of $3. So they do some special payouts, and that is what these spikes are right here on this graph. So whenever it spikes up like that, that's a special payout. But they're currently paying out 60 cents per share right now. They've been paying out dividends for quite a while. And at the top of Dividend.com, it says they haven't had any growth in the last year, but this could be 60 cents. So it looks, yeah, it looks like they haven't increased their dividend since back in 2015 going into 2016. They increased it to 60 cents. So it has been over a year since they increased it. So if you're buying into this stock, you're not buying it to buy and hold for the dividend increases. You're basically buying it thinking it may appreciate because the price and yield, $48.54. It has came down hard into the new year. It was nearly at $62, now at $48. Yield is at nearly 5%, but you can see that this one, it goes down to the $30 range all the way up to the $62 range. So this one almost doubled, nearly 100% gain if you had rode this one up from September all the way into January and sold it. But very risky stock. You can see that there's no really support. You may have thought this was a support line right here and held it. It came down, hit the support, and if you had bought it during this time thinking, hey, I'm going to load up on this because this is the support level, and then it tanked by 50% there or more, you would need, looks like a 25% drop, and then you would need 50% back just to get back to that point, and then another 50% to get up. But of all of these stocks, I think AFL and Southside seem like two of the less risky ones. LB and DNB seem like some of the higher riskier ones. So those are 4 stocks with ex-dividends next week that look like potential. I'm not going to say that they're great buys, but they have good revenue, free cash flow, net income. They all have PEs less than 25, yields greater than 2%. AFL's been paying dividends for 30 some years, I believe, if not longer. If we go back over to dividend.com, let's just take a look at these very quickly if you guys would like to stay around. Southside and DNB. So here we are. We have AFL 35 years of increasing dividends. SBSI 20 years of increase in dividends, and DNB 11 years of increase in dividends. So again, SBSI, AFL, I think AFL would be the safest choice, followed right behind by SBSI, then DNB, and then I wouldn't risk it with LB Brands. That one swings very wild. You could potentially buy it at a very low point and maybe ride it up, or it could just flop again. So who knows? But that is it. That is it for this video. If you guys have enjoyed the video, remember to like, comment, and subscribe. I know this is kind of different than going through my website and I have everything typed out, but I'm trying to decrease writing articles that are just kind of writing in the wind that won't really get looked at in the future. Similar to these kind of videos, I mean, these videos, I look at them 3 months ago, and some of the same stocks that we covered 3 months ago were like, man, these were great buys 3 months ago. We had a yield of over 6%. Imagine, this is probably one that I covered 3 months ago, and I was like, it's an undervalued stock. If you had bought it, you could have ridden it up, 70, 80, 90%. But just as far as keeping an article on my website for others, historical stuff, not as important. So I'm going to try and keep my website with more information that you can just visit the website, get information there, or research that goes to a video that has like a specific topic covered for that, what you're looking for. So if you do have anything else to add, go ahead and leave it in the comments below. I am a little bit sick right now, so I feel, well, it may sound congested, but that is it for this video. I will talk to you guys later. Have a great day. Bye-bye.